ExamPrep.School, Rhode Island life insurance producer Exam, exam code INSRI-Life1 or OPLife01. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1: completing the application, underwriting and delivering the policies, policy writers, provisions, options, and exclusions, RI laws, rules common to life, pluses, accident and health, RI laws, rules pertinent to life insurance, plus annuities only, retirement and other insurance concepts, types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which feature of an ordinary whole life insurance policy ensures the policy's premium payments remain constant for the duration of the contract? A. Limited pay premium structure. B. Level premium funding. C. Adjustable death benefit. D. Annually renewable term rider. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The level premium funding feature spreads the insurer's mortality and expense costs evenly over the life of the policy, keeping premiums constant. Reason A is not correct. This describes a limited pay policy design, not the feature that holds premiums level over the entire contract. Reason C is not correct. An adjustable death benefit is a universal life feature and does not guarantee level premiums. Reason D is not correct. An annually renewable term rider does not affect the base policy's fixed premium schedule. Question 2. In a 10-pay whole life policy, which statement correctly defines the premium paying period? A. Premiums are fixed and paid for 10 specified years. B. Premiums continue until the policy's cash value equals its face amount. C. Premiums are payable until the insured reaches age 100. D. Premiums vary based on the insurer's investment performance. The correct answer is A. In a 10-pay whole life policy, the premium schedule requires fixed payments over 10 years, fully funding the policy thereafter. Reason B is not correct. Cash value equaling face amount occurs at maturity but does not define how long premiums are paid. Reason C is not correct. That describes standard whole life maturity and does not specify a limited pay period. Reason D is not correct. Variable premiums tied to investment performance are a feature of universal life, not a 10-pay whole life policy. Question 3. Which characteristic distinguishes a single premium whole life insurance policy from other whole life designs? A. Premiums are paid over a limited number of years. B. A one-time lump sum payment fully funds the policy at issue. C. Premiums are guaranteed to remain unchanged for life. D. Premium payments are adjustable based on cash value changes. The correct answer is B. A single lump sum payment at policy inception fully funds the coverage, unlike ongoing or limited payment designs. Reason A is not correct. Limited pay designs require multiple periodic payments, not a single premium deposit. Reason C is not correct. While ordinary whole life premiums are level, that design does not use a single lump sum funding. Reason D is not correct. Adjustable premiums linked to cash value are a universal life feature, not single premium whole life. Question 4. Catherine purchased a participating whole life policy featuring both guaranteed cash value accumulations and non-guaranteed dividend additions. At the end of its 10th year, her policy statement reports a total cash value that includes paid-up additions and a guaranteed cash value schedule. Which portion of her cash value is guaranteed by the policy contract? A. The portion purchased with dividends is paid-up additions. B. The total cash value, including paid-up additions and dividends. C. The guaranteed minimum before applying any dividend-based additions. D. The surrender value net of outstanding policy loans and accrued interest. The correct answer is C. The correct answer identifies the guaranteed minimum cash value specified in the policy schedule, which excludes non-guaranteed dividend additions and reflects the contract's guaranteed accumulation. Reason A is not correct. It is incorrect because paid-up additions purchased with dividends are non-guaranteed and subject to dividend declarations. Reason B is not correct. It is incorrect because the total cash value includes dividend additions that are not guaranteed by the contract. Reason D is not correct. It is incorrect because surrender value net of loans reflects policy loans and interest, not the guaranteed accumulation schedule. Question 5. After 15 years, Luke's whole life policy shows a face amount of $250,000, a cash value of $50,000, and an outstanding policy loan of $10,000. When comparing the face amount to the cash value, which statement correctly contrasts these policy values? A. Face amount represents the death benefit payable at the insured's death, while cash value accumulates as a living benefit the policy owner can access. B. Cash value remains level throughout the policy term, while face amount grows at a guaranteed minimum interest rate. C. Face amount equals the policy's cash surrender value less outstanding loans, whereas cash value is paid at death. D. Cash value available upon surrender decreases by the loan amount, but face amount stays level regardless of loans. The correct answer is A. The correct answer distinguishes that face amount is the death benefit paid to beneficiaries, whereas cash value is a living benefit that accumulates and can be accessed by the policy owner during their lifetime. Reason B is not correct. It is incorrect because face amount remains level and does not grow, and cash value increases over time rather than remaining level. Reason C is not correct. It is incorrect because face amount is not based on cash surrender value minus loans. Instead, it is the full death benefit. Reason D is not correct. It is incorrect because while loans reduce cash surrender value, face amount remains level but is not impacted by loans. Question 6. In a level term life insurance policy, how is the death benefit amount structured over the term of the policy? A. The death benefit decreases annually to match a scheduled reduction. B. The death benefit increases gradually to compensate for inflation. C. The death benefit remains constant throughout the specified coverage period. D. The death benefit varies based on the insured's attained age. The correct answer is C. The correct answer is level term maintains a fixed face amount for the entire term, unlike decreasing or increasing structures. Reason A is not correct. This describes a decreasing term structure, not a level term. Reason B is not correct. Level term policies do not include inflation adjustments that increase the benefit. Reason D is not correct. The death benefit does not fluctuate based on the insured's age in a level term policy. Question 7. Which characteristic best describes a decreasing term life insurance policy commonly used for mortgage protection? A. The face amount stays constant, but premiums decrease annually according to loan balance. B. Both the face amount and premiums decline in parallel to diminishing debt. C. The policy's face amount diminishes over the coverage period while premiums remain level. D. The face amount increases annually to offset inflation with level premiums. The correct answer is C. The correct answer describes decreasing term used for mortgage protection. The face amount shrinks to mirror the amortizing mortgage while premiums remain unchanged. Reason A is not correct. In decreasing term, the face amount, not the premium, is scheduled to decline. Reason B is not correct. Premiums do not decline in a standard decreasing term policy, they remain level. Reason D is not correct. Decreasing term does not feature benefit increases or inflation indexing. Question 8. In annual renewable term life insurance, how do the premium payments typically change? A. Premiums increase at each renewal based solely on the insured's current age. B. Premiums remain fixed for the duration of the policy term. C. Premiums decrease after the first year due to mortality savings. D. Premiums increase gradually during the initial 5 years, then level thereafter. The correct answer is A. The correct answer reflects that annual renewable term premiums reset each year and escalate in line with the insured's attained age without accumulating cash value. Reason B is not correct. Premiums are not fixed. They adjust upward each renewal based on age. Reason C is not correct. Mortality savings do not cause premium decreases in annual renewable term. Reason D is not correct. There is no multi-year leveling. Premium increases occur each year. Question 9. Sandra purchased a 20-year return of premium term life policy. At the end of the 20-year term, she has not made any claims. Under which condition will the insurer refund all premiums with no deductions? A. Upon cancellation within the 30-day free look period. B. Following the policy's grace period if premiums were paid late. C. At the policy's expiration date if no death claim occurred. D. If the insured converts to a whole life policy before term expiration. The correct answer is C. The correct answer is at the policy's expiration date if no death claim occurred, because return of premium term policies refund all paid premiums only when the insured outlives the full term without filing a claim. Reason A is not correct. Cancellation within the free look period triggers a full refund of initial premium, but not a return of premium term benefit at term end. Reason B is not correct. Grace period relates to late payments and does not trigger a refund of accumulated premiums at term expiration. Reason D is not correct. Conversion to whole life changes the contract type and does not refund prior term premiums. Question 10. Marcus holds a convertible 10-year term life policy with a specified conversion period of the first 5 policy years. What does the conversion period allow him to do? A. Cancel the policy and receive a partial cash value during the initial 5 years. B. Renew the term coverage for an additional period at a lower face amount. C. Exchange the policy for a permanent policy at standard rates without proof of insurability during the first 5 years. D. Extend the term period beyond 10 years by paying an extra premium through year 5. The correct answer is C. The correct answer is exchange the policy for a permanent policy at standard rates without proof of insurability during the first 5 years, because the conversion period defines when conversion rights exist without new underwriting. Reason A is not correct. Term policies have no cash value to cancel for a refund during the initial period. Reason B is not correct. Renewal extends term coverage but does not grant conversion to permanent policy rights. Reason D is not correct. Extension of term is a renewal feature, not a conversion to permanent coverage option. Question 11. Which of the following best describes the flexible premium feature of a universal life insurance policy? A. Allows the policy owner to adjust the premium amount and payment schedule within the policy's contractual limits. B. Requires level premiums for the policy's duration, set at the time of issue. C. Ties premium adjustments strictly to prevailing market interest rates. D. Permits premium payments to be waived indefinitely if the cash value exceeds premiums paid. The correct answer is A. The flexible premium feature permits the policy owner to vary both the amount and timing of premium payments within minimum and maximum limits, distinguishing universal life from fixed premium policies. Reason B is not correct. This describes a level premium structure which applies to whole life but not universal life. Reason C is not correct. Premium adjustments are at the owner's discretion, not automatically linked to interest rate movements. Reason D is not correct. There is no indefinite waiver of premiums. Cost of insurance charges continue to apply even if cash value is sufficient. Question 12. In a universal life policy, the cost of insurance charge is primarily determined by which factors? A. The policy's minimum cash value and current interest rate underlying the separate account. B. The insured's attained age, the net amount at risk, and the insurer's mortality rates. C. The total premiums paid multiplied by the current expense loading factor. D. The policy's cash surrender value and a fixed mortality table. The correct answer is B. The cost of insurance charge reflects the mortality risk and is calculated using the insured's age, the net amount at risk, death benefit minus cash value, and the insurer's mortality assumptions. Reason A is not correct. Charges are based on mortality risk, not on cash value or interest rate components. Reason C is not correct. Expense loadings and total premiums paid do not directly determine the mortality charge. Reason D is not correct. The charge uses the net amount at risk rather than the cash surrender value against a fixed table. Question 13. Which statement correctly describes how the accumulation account in a universal life policy functions? A. It establishes a mandated reserve held by the insurer that remains unaffected by interest rate changes. B. It accrues cash value as premiums are credited net of cost of insurance charges and earns interest at the current declared rate. C. It is segregated into fixed and variable subaccounts that mirror market performance. D. It establishes a minimum paid-up insurance benefit once a specified cash balance is reached. The correct answer is B. The accumulation account credits premiums after deducting cost of insurance and expense charges, and it earns interest at rates declared by the insurer, forming the policy's cash value. Reason A is not correct. Reserves and interest sensitivity are integral to universal life cash values, so it isn't insulated from rate changes. Reason C is not correct. Fixed and variable subaccounts apply to variable life, not to a standard universal life accumulation account. Reason D is not correct. Accumulation accounts grow cash value but do not automatically convert to paid-up benefits at any threshold. Question 14. A policyholder's interest-sensitive whole life policy has a current declared annual interest rate of 2.0% and a guaranteed minimum rate of 2.5%. The insurer's net investment yield for the period is 4.3%. What annual interest rate will be credited to the policy's cash value for the current period? A. The guaranteed minimum rate of 2.5%. B. The declared rate of 2.0%. C. The insurer's net investment yield of 4.3%. D. An index-linked bonus rate based on market performance. The correct answer is A. The credited rate cannot fall below the guaranteed minimum. And when the declared rate is below that guarantee, the guaranteed minimum rate applies. Reason B is not correct. Because the declared rate is below the guaranteed minimum, it is not used. Reason C is not correct. The actual portfolio yield exceeds both declared and guaranteed rates but is not directly credited. Reason D is not correct. Indexed bonuses do not apply to interest-sensitive whole life policies' credited rates. Question 15. An indexed universal life policy credits interest based on S&P 500 index performance. For the current period, the index gained 9.0%. The policy specifies an 80% participation rate and a 5.0% cap. What annual interest rate will be credited to the policy's account for this period? A. 9.0%. B. 7.2%. C. 4.0%. D. 5.0%. The correct answer is D. When the participation-based yield exceeds the cap, the cap limits the credited interest, so the credited rate is the 5.0% cap. Reason A is not correct. The full index gain is not credited because the policy applies participation and cap limits. Reason B is not correct. The participation yield exceeds the cap and must be reduced to the cap level. Reason C is not correct. Subtracting the cap from the index return is not how cap features function. Question 16. An immediate annuity generally requires the first payment to occur at which time following the contract issue date? A. On the contract issue date specified in the policy schedule. B. On the first scheduled payment date after contract issue. C. At the conclusion of the free look examination period. D. Upon completion of any guaranteed minimum payout period. The correct answer is B. The correct answer is that an immediate annuity's first payment is made on the first scheduled payment date after the contract issue date because immediate annuities begin payout within one payment interval following issuance. Reason A is not correct. Immediate annuity payments do not occur on the issue date. They commence after the first payment interval. Reason C is not correct. The free look period affects cancellation rights and does not determine payment initiation. Reason D is not correct. Guaranteed payout periods relate to minimum benefit guarantees, not the timing of the initial payment. Question 17. During the accumulation phase of a deferred annuity, funds primarily grow through which mechanism? A. Interest credited at a declared minimum rate during accumulation. B. Earnings accumulating on a tax-deferred basis until annuitization. C. Mandatory partial annuitization of contract value before maturity. D. Penalties assessed for withdrawals before the accumulation period ends. The correct answer is B. The correct answer is that during the accumulation phase, a deferred annuity's earnings accumulate on a tax-deferred basis until annuitization, which is the defining feature of this phase. Reason A is not correct. Although interest crediting occurs, the key feature is tax deferral of earnings rather than merely a minimum interest rate. Reason C is not correct. Deferred annuities do not require mandatory partial annuitization before maturity. Reason D is not correct. Withdrawal penalties are a disincentive, not the mechanism by which funds grow. Question 18. A single premium annuity is funded by which type of premium payment structure? A. Multiple flexible premium payments scheduled during the accumulation phase. B. A single lump sum premium payment made at contract inception. C. Regular deposits according to a fixed contribution schedule. D. Employer-sponsored contributions supplemented by optional policyholder additions. The correct answer is B. The correct answer is that a single premium annuity is funded by one lump sum premium payment at contract inception, distinguishing it from annuities that allow multiple contributions over time. Reason A is not correct. Multiple flexible payments describe flexible premium annuities, not single premium structures. Reason C is not correct. Regular deposits suggest periodic contributions, whereas single premium annuities use one lump sum payment. Reason D is not correct. Employer-sponsored contributions are not characteristic of single premium annuities. Question 19. Jason's deferred annuity contract permits deposits at any time above a $250 minimum, up to an annual ceiling of $50,000 with no penalty for varying the timing or amount of payments. He sometimes contributes monthly and other times pauses contributions entirely when his income dips. Which annuity contribution pattern best describes this arrangement? A. Single premium immediate annuity. B. Flexible premium deferred annuity. C. Fixed premium deferred annuity. D. Variable annuity with level deposit requirements. The correct answer is B. Flexible premium deferred annuities allow contract owners to make deposits at irregular intervals and varying amounts within specified minimum and maximum limits, matching the scenario described. Reason A is not correct. Single premium immediate annuities require a one-time lump sum purchase and begin payouts immediately, unlike the variable deposit schedule here. Reason C is not correct. Fixed premium deferred annuities mandate level pre-specified payments over time rather than allowing payment flexibility. Reason D is not correct. Variable annuities relate to investment risk exposure and typically still follow scheduled deposit requirements, not flexible payment amounts and times. Question 20. Under a standard waiver of premium rider, policy premiums are waived when the insured has been continuously totally disabled. For which condition? A. Immediately upon submission of proof of total disability. B. Once total disability has lasted 30 consecutive days. C. When total disability extends beyond the policy's incontestability period. D. After satisfying the contract's elimination period for total disability. The correct answer is D. The waiver of premium rider requires the insured to satisfy the elimination period specified in the contract before premiums are waived and any retroactive premiums are refunded. Reason A is not correct. Waiver does not begin immediately. Proof must be followed by the required elimination period. Reason B is not correct. 30 days is shorter than the typical elimination period and not the standard trigger. Reason C is not correct. The incontestability period relates to contesting the policy, not triggering premium waiver. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.